This is Redline Money. I'm Carolyn Wright, and with the expert help of Richard Harris of Port Shelter Investment Management and David Roach of Independent Strategy, we'll take a weekly delve into the future of the economy by finding out where their red lines lie and what you need to know as an investor. Today, I'm going to get a little bit technical with you guys. We're going to delve into what has been known as Fed speak, the term coined by the economist Alan Blinder as a turgid dialect of English used by Federal Reserve Board chairmen in making wordy, vague and ambiguous statements. Now, I don't know if they necessarily do that so much nowadays. Jay Powell seems a bit clearer in what he says, but I'd like to just talk about how you interpret what they're saying.
Well, what you do is you go to Richard.
Yes.
Who's that guy?
That guy over there.
Over there. And you get him to use one of his spooky text analysis things, which compares the written text of this gobbledygook, which they come up with, to the gobbledygook from the previous meeting. And it will underline all the changes in commas and commas and semicolons and words. So that when you've got that and then you extract that, you have a new form of Fed speak, which tells you what were the significant changes, which is all terribly exciting. And that's one of the things that Richard is terribly good at. I'm not very good at it.
Right.
It's very exciting stuff.
I always remember Alan Greenspan saying if anybody understood him, he was speaking too clearly, which is certainly true. And I think Powell speaks clearly, but maybe with forked tongue, because we've had the situation. It does look as if the Fed is now on a starter to go, finally admitting that the direction of travel for interest rates is up. Not exactly a secret, because I think the rest of us have been thinking that for a long time. And indeed, even Janet Yellen let the cat out of the bag a few weeks ago. So we're on a path now, and I guess the thing is, how do we interpret the tea leaves and the Fed speak and all the pearls of wisdom that fall out of it?
Exactly. So it's what are they likely to say, and what does that mean for people who are investing?
Well, I'll say one thing which will be tremendously valuable to investors, which is you can get the event right. Let's say they come in 2 months or 3 months and they say, well, actually, we've pumped so much money and there's so much fiscal stimulus in this economy, inflation is probably not quite as transitory as we thought. Transitory being the most inflation-prone word in the English language because it's used until it all but loses its meaning.
Inflationary.
Yes, and then they come in and then the markets do something completely different to what normally would happen. Let me elucidate on this. And frankly, I've got to say, this is one of the reasons why I don't want to be reincarnated as a strategist. I want to be reincarnated as a pet dog, preferably my own, which of course under quantum physics is possible under multi-world universe.
It'd be well looked after anyway.
Yes. Let me explain what I mean. So the Fed, hypothetically, comes along and says, oops, someday, somewhere, we're going to maybe have to increase interest rates. Ooh. And the median has gone up by 2 in such a period, which is, of course, over 1.5 years away. Now, you would think rising interest rates would have a certain number of effects.
You would?
And Richard, who is going to have to explain this to us succinctly, you would think that rising interest rates would raise interest rates. You would think
seems
that
logical
bond
enough.
rates would rise because the Fed is going to someday charge more for money. Instead of which, the long bond rates fell. Only the short-term rate increased. Richard can explain that.
So what's going on? Yeah.
No, don't ask him yet.
All right.
We have to
got to build up to it.
Stoke the fire. The second thing is, the U.S. is an economy which has got massive deficits, twin deficits, budget deficits, savings deficits, external deficits, and I can go on. That's not twin, that's 3.
Yeah.
But it doesn't really matter. I'd like.
Who's counted?
It doesn't matter. So you would think that admitting that this is the case and that this is over-fueling economic growth, making it too high, you would think that would weaken the dollar. But no, the dollar went through the roof. The euro went from 120 something or other to 118 something or other.
Yep.
Only the yen, and we all know that the yen is the mirror image of Japan, which is happy as mimicking a corpse. They did nothing. But everybody else, including the Norwegian kroner, which is, the solidest and bestest and everything else currency in the world, went down 5% and so on. So currencies did the opposite of what you'd expect. And finally, of course, equities, shut up for a minute. I'm actually giving you stuff to occupy the rest of the podcast.
You're giving me the ability to explain the unexplainable.
Exactly. And the final thing is, of course, equities went down. Now, I can see the reason they went down. They went down because interest rates might go up and there's a discount factor and inflation might go up, so profits might be less real and less of them. And the combination of the two plus cyclicality might encourage people to hold a few less equities. But I mean, Richard, the problem is, which you have to explain, is why you can get the events right when you forecast them, and the effect of those events on assets is completely the opposite to what should happen, which is why I don't want to be reincarnated as a strategist, but as a pet dog. Tell us.
Yeah, because we're operating in a complex system where there are features coming in we don't even know about, the unknown unknowns we don't even know about yet. I mean, I'm actually with you, David, in terms of the fact that when you get a shock like this, in this case, equities down, bonds up, dollars up, it's normally an indication of what might happen in the future. And very often it goes away, as we've seen. But, one should keep that in our minds as being the reaction for when the balloon really does go up. However, I'm not so sure in this case, because I think, we're now in a world of narratives. We've gone past a situation where we thought interest rates up means bonds down. People are diving into all sorts of things. There's huge amounts of liquidity around. So there's no real sense in a way. And I think we're in a transitory phase, to use an overused, inflated word, which is where the markets don't really know where they're going. They don't really know where to price in. Bond investors don't really want to dive out of bonds, even though they look like a terrible investment. So we're kind of in this phony war where liquidity is pushing asset prices up. And yet we've got this situation where we may get inflation, which we haven't had a long time, and interest rates going up. So I think it's all about the narrative. And the issue with the timing is that the narrative can be different at different times. So if you have a positive narrative, as we have relatively at the moment in terms of economies and markets, Fed increases rates, who cares? We're fine, we're going to be okay. They're only small amounts anyway. Whereas in a more critical phase, and I think maybe that critical phase may come looking further on, when the market realizes the Fed's not really in control, and that's when the market may start to wobble.
I think that's actually rather well put.
I think he did an excellent job there. You built him up and he went off.
He went off and he went
Thank you. I'll pay you later.
Let me just resume that for the average punter. So for the moment, if the Fed continues to threaten or deliver higher interest rates, bond yields would fall and short-term treasury notes, 2 years, would actually rise. That's one. Two, the dollar would be strong, not weak, as a result of that, even though it is actually indicative of a structurally weak dollar. And third, equities would really start to worry about higher discount factors and lower real profits and the cyclicality that is attached to both. And then you're saying, okay, that'll be fine. We'll live with that. It might be 3 months. It might be 3 quarters because we don't know. But then we go back to the scenario where the weakness of the US dollar is exposed because the twin deficits are too high in the United States. So it starts to go down, which would be normal for it to go down before investors poured in money to finance those twin deficits. Interest rates go up at the short end, but they also go up at the long end because the inflationary consequences are not easy for the Fed to control. And I would have thought that the currencies, we've said that the dollar would start to be pretty weak, but I think it's the transition. You're talking about doing, as an investor, one thing now, but being very fleet of foot and ready to do another thing down the road. Is that right?
It seems like it.
Yeah, I think that.
So it's what's the trigger for that switch?
Well, the word that Richard used is narrative.
Mm-hmm.
And the narrative changes.
So many of these Fed members seem to have different views. You've got Williams coming out saying, oh, we've got to be very dovish. You've got Bullard coming out saying, well, maybe rates are next year. You've got Powell appearing to come out and changing everybody's view in front of the press. So stick with this pod and we'll lead you through the narratives.
Redline Money takes the expertise of David Roach of Independent Strategy and Richard Harris of Port Shelter Investment Management as they talk markets, prices, bubbles and busts, and some even more interesting topics. David and Richard have nearly a century between them of searching for the red line in bull markets and bear. Hear what the crowd isn't saying about current markets and price moves in the long term and even longer, back to the Egyptians. See markets as an engineering system, a biological organism, or as the behaviour as subatomic particles. You don't get this anywhere else, and you know it makes sense. I'm your host, Carolyn Wright. Music is by Tim Moore at Pixabay, and Redline Money is produced in Hong Kong. It's available at redlinemoney.online.